Well, I'm sure you're as bummed as we are. We're on our final quarter of our first hour with Chris Ingram with Infinity Wealth Management. And I hope you've been paying attention. If you missed anything, you can go to our website at donandgino.com and click on the Listen Live button, and the show will be there. Basically, as soon as we're over, you can replay it, and I think you should, and I think you should share it with your friends, because this is pertinent information that could change their lives, absolutely change your life by making sure you're prepared, because we were talking about the Dow being at all-time highs. Exciting, woo, euphoric. But there are some concerns, and there's some concerns for a lot of you out there, because we're, as you know, at all-time lows with interest rates. And interest rates, believe it or not, a lot of you probably don't even know, can affect your bond portfolios, meaning your fixed assets, the things that you feel are very safe in your portfolios. And Chris is bringing to light some of those concerns. And we thank you for joining us again, Chris.
You're welcome. Thanks for having me.
And bringing up those concerns. And I know Gino wants to jump in about an example.
I do want to jump in about an example, but and the idea of this example is to talk about how important this really can be, how much money it can mean to you. We just talked about
and the solutions. There are options.
But we just talked about 30%. That could be devastating. It could take years to recover from something like that. And you've got some information on on something that I would love to have this problem. So let's talk about that for a minute and what the impact is on some of the larger deals.
Well, yeah, let's explain why interest rates affect this asset class. So I'm working with a client right now. They have $75 million trapped up in a 5-year treasury. They've been in it for about 3.5 years right now, and the yield on it is 2.25. If they sold that treasury today, somebody would be willing to pay them $78 million for that bond. So that's a $3 million increase in the value of that bond. And the reason is that bond that they're holding is paying 2.25. Nobody can go get that on the market right now because interest rates have come down so far. So people are willing to pay them a premium for that bond.
As of right now.
As of right now.
Correct.
The opposite is
now,
true.
Now, the fixed income piece never changed. It's still 2.25.
Correct.
So someone is purchasing a rate of return by buying that bond. They're saying, I would like 2.25 as a rate of return on my money.
Correct.
And right now, because they can't get it anywhere else, they have to pay a premium to this person because they hold that note.
You got it.
Okay.
Perfect.
Good.
So on the flip side, and this is where the concern comes in if interest rates were to rise, is if you take that same type of portfolio, if you take $75 million and you go invest it at 1% right now, and a year from now, that same $75 million can be invested in the same bond for 2% or 3%. Nobody wants your 1% bond. So selling it is very, very difficult. So what do you have to do to entice somebody to buy your $75 million bond? You have to sell it at a discount. So the only way they'll be willing to buy it from you is if you'll sell it for maybe $72,000 or $72 million, excuse me, $72 million or
I'll buy it for $72,000.
Yeah, $72,000.
I don't have it, but I'll figure out how to get it
Peter
out.
just came across the table and goes, I'll find the money.
That would be a great deal. Yeah, so you sell it for $72 million or $70 million. You have to take a loss on that bond in order to sell it, because interest rates are now higher on the current market than the bond that you're actually holding. So a rise in interest rates is going to cost you money if you have to get out of those positions.
Millions, potentially
millions.
of
If you're talking about a portfolio of that size, but even
but
if
it's all
$100,000, it's all relative.
Yeah.
You have a $100,000 bond, you're going to have to sell it for $90,000.
Right.
You're still going to take a loss.
Right.
But now what I think is really important about that is that we look at it and we say, that's someone that was supposedly getting a good advice. That's someone that was supposedly safe. And you're taking a look at it now going, hey, not so safe. All your eggs are in one basket. Let's break this up. Let's do something different with it. Let's make sure you are safe.
That's correct.
Okay.
So you were giving us, what's really good for you out there is, you're hearing, oh no, I might be in big trouble. And you might be if you have all your eggs in one basket thinking you are very safe. And you can ask your professional or anyone, that, yes, the bonds were the safe haven for years now. I mean, how many years has it been? Like 7, 8 years has been the
I mean,
10
you
years?
can actually go
I mean,
back. It's something like a 20-year bull market in the bond markets. Correct.
So
The
everybody's
model-
gotten comfortable with it, or complacent.
Yeah.
Complacency is always an issue.
Correct.
I know I can't get complacent with my wife, or I'm in trouble.
No, but let's talk about that for 1 second, because it's not just about safe. It's actually been profitable.
Yeah.
It hasn't been safe. It's been profitable.
Well, like we were talking about that $75 million position,
Yeah.
they've made money because interest rates have been falling, and bond portfolios have done excellent during this time period.
It doesn't mean they can't keep going up, but it's highly unlikely. So it's just a question of be careful, proceed with caution, make sure you're diversified and protected.
It's less about if and more about when interest rates start to rise.
That's a guarantee. Right there with death and taxes. Interest rates will go up. And you heard it right here on the Donna Gino Real Estate and Finance Show. We're letting you know. Now, it might not be tomorrow, but they will go up, and it will affect your portfolio. So, Chris, now we've been talking about be careful about rates going up can decrease your portfolio. There are options for them if they go to a professional and prepare for this.
Right. Yeah, so don't go sell all your bonds and start stuffing your mattress full of money. That's not a good idea. So what you want to do is you want to sit down and you want to look at your portfolio, look at your allocation, and come up with some ideas to protect. So some of the things you can do is you can move your fixed income investments to the shorter end of the yield curve, so only maturities in 1, 2, 3 year ranges. Not that there's no risk there, but the risk is less when you're holding shorter maturities.
So that's like a short-term CD. People are comfortable with that. They understand that. They need some liquidity.
Right.
It's short-term, not a lot of damage there.
If you don't have to sell it during that 2-year period, then at the end of the 2 years, it's going to mature and you get your money back. So you have less risk of needing to sell it and taking a loss on that position during that time period. So that's the idea of moving to shorter duration. The other thing is there's something called floating rate notes. Floating rate notes it's a variable rate, and that rate will increase as interest rates increase. So there's floating rate mutual funds, floating rate ETFs out there that you can add to the portfolio that will actually take advantage of a rising interest rate market. So you can swap out some of your other fixed income assets and move into some floating rate positions to better allocate your fixed income portion of the portfolio. You can do what other people have been doing over the last couple of years, which is move to dividend-paying stocks and riskier assets. That's one of the things that's been driving the market higher as people are coming out of these fixed income positions that aren't paying enough money and moving to these riskier assets to find higher yields. So maybe you don't put it all there, but maybe you increase your exposure to your dividend stocks in the portfolio right now because they kind of carry a similar risk at the moment to some of what was considered your conservative, safer investments. So it's just about reallocating and manipulating the portfolio to stay in line with what your risk tolerance is and what your goals and objectives are, but to protect if something changes going forward.
Well, I know I learned something from Chris. If you just tuned in, you listened to some great advice from Chris Ingram with Infinity Wealth Management. Been out here helping you and us. He's been guiding you to personal financial wellness right side by side with us since 1998 out here. And he's doing a great job of informing you what you need to do to protect yourself. And also, we always say there's solutions and opportunities, and Chris has just shared with us some great opportunities with the potential rates going up, and rates will go up, and how to protect yourself. So please reach out to Chris. It was at 255-8555?
255-9555.
That's close.
Oh.
255-9555.
That was close, just off by one.
Yes.
Yeah.
So
Or reach out to us if you can't write that down.
More
right
fives.
now. DonnaGino.com.
There you go.
It's easy.
Perfect.
Website.
Very cool. And Chris, we enjoy you being part of our show, being part of the Professional Resource Group, which is a group of the very best of the best professionals that we can find in this valley. Chris, we're proud to have you part of that.
Thank you very much.
Thanks for being part of our show. Make sure you check out this show and share it with your friends. At donandgino.com, click on the Listen Live in this show. You will actually be able to see the video of the show. Get to see the good-looking, well-in-shape Chris Ingram on our show. And check out the advice he gave you and share it with your friends because it was great advice. Thank you, Chris.
Thank you very much for having me.
I know we learned a lot.
I really enjoy sharing the information, so I appreciate it.
Yeah,
No, it's absolutely fantastic, and someone who was listening today could be on a better road to financial wellness. So
that's right. You talked about how to save thousands, tens of thousands, if not
Even
millions.
Yeah, save millions of dollars.
There we go. Right here.